better than expected economic data out on Friday, but on the other end, we're seeing the dollar strengthening slightly and the yen rising as well, which usually signals that we are seeing a bit of risk aversion.
No, that's right. That panic trade that we saw last year, where, as you say, the dollar strengthens and the yen also strengthens, and other things sell off. But we're not seeing that trade making headway. We're seeing signs of it coming through, but it's not really following through. So in other words, the yen has strengthened, but it's not strengthening to the to new levels at this stage. But it might still do. There's other funny signs. The yield curve is steepening again, which is sell-off of that's the US yield curve selling off of the long end, but the short end, the yields, the bills are back at zero, and that does suggest that there's still a very strong risk aversion.
Well, at this stage, we know it's December, and clearly things have slowed down quite significantly. Is this one of the reasons that we're seeing a market sort of trading a bit sideways and also coming under pressure?
I think so, but I think there's two disconnects in a sense. The one is you're seeing that the recovery in the economic data, things like inflation and GDP and that kind of thing. But behind that, the actual financial situation is still not exactly repaired. You've still got the bad debts, the commercial property side also not looking healthy at the moment, and I suspect that's why there's still a huge reluctance in terms of the market just to go flat out. Clearly, zero interest rate policies are an enormous important driver to financial markets, which is why risk assets have done better this year than it did last year, for instance. But there is that underlying concern of bankruptcy, and then of course the sovereign bankruptcy risk, or the sovereign solvency with Dubai, Portugal, Greece and Spain also coming under pressure. The Baltic states, there's some there that's that's problematic. Eastern Europe problematic as well.
Are you concerned that we could see a default come 2010, or do you think we're going to see significant bailout packages for these countries?
Well, a national default is often covered in certain ways in terms of restructurings or other entities coming into the fray, like the IMF and World Bank. So it's going to be interesting to see how this pans out, but we're seeing spreads of vulnerable countries widening out.
Chris, looking at the South African economic environment, retail sales really disappointing, mining and manufacturing still in the doldrums at this stage, and of course we've got that key MPC meeting in January, early January next year. Do you think we could see an interest rate cut? Do you think it's warranted at this stage?
Whether it's warranted, I'm of the belief that interest rates probably are where they should be in terms of the low of the cycle. I wouldn't discount another cut. But
do you think we need it though, Chris?
My personal belief is that there's an overemphasis on what interest rates can actually do for an economy. Obviously, it's a very important driver, but without doing the other things in the economy, in other words, looking at the engine rather than just the accelerator and the brake, one needs, it may well be futile, because what we do run the risk by just cutting interest rates is moving towards a consumption-led boom. So we go effectively into the pump and dump, which is not it's not healthy, over the longer term.
After the dot-com crisis in 2000, 2001, we saw the equity markets really trading sideways for some time. Do you expect that is going to happen this time around, or do you think that all the stimulus that we've seen, of course, all the excess liquidity is going to translate into equity markets rising significantly?
It'll translate into equity markets rising. We've already seen some of that. But ultimately,
even further from these levels.
Ultimately, there's tears at the end, so you may well see a further rise, and it could last for another 6 months. I don't know.
So what you're saying, we're heading into another bubble?
We're heading into another bubble. That's not sustainable. Unfortunately, you do get malallocation of capital when you get interest rates too low. When it was cut in the wake of the dot bombs, effectively interest rates were cut to 1%. and we spurred the property bubble, which of course led to a huge hangover in the financial sector. What's the next? When you cut interest rates to zero and flood the system with
So what
even
is the
more
next bubble,
liquidity.
Chris?
Well, we're looking at equities as one of the things, and emerging markets may be another area, commodities, etc., may be another area.
But surely investors out there listening think, okay, maybe perhaps we should be riding the bubble and try and make as much money as possible now.
Oh, absolutely, absolutely. The only trouble is
You have to know when to leave.
most are not clever enough to actually get out.
Okay, so looking at your portfolio as well, Chris, I mean, how are you playing things right now?
Well, we're looking, I think the best positioned portfolio is something like some of the asset managers which have got a combination of precious metals and defensives. In this kind of environment, obviously a bubble environment, you're spurring the risk of inflation, which is what gives you outperformance in the precious metals. But the defensives don't perform as well, but it'll give you protection, if things turn down, and that's basically the kind of portfolio which I think is very favourably positioned at the moment.